Sunday Supplement Live time, and this week's I decided to call Spotlights in the Wrong Places, and you'll see why that comes about. So if you haven't listened before, I'm sure you won't know, but I like to start with a quote, and this week's is "Stay true in the dark and humble in the spotlight," and that's from Harold B. Lee, the religious leader / educator. So before I get started for real, it's basically last call time for the final property business workshop of 2024, Tuesday the 1st of October. It's almost eerie how when we first planned this workshop some months back, we chose this one as the one to cover exits. And then look what's happened in the interim. Well, firstly, it's about planning your own, which people do very poorly in our experience. And secondly, so you can understand what other people's exit plans or lack of them and assist with them when looking to buy a portfolio or a business. So help the vendor get what they want, need and deserve, and work towards a true win-win situation. As always with all of our workshops, it will be an action-packed, standalone, content-filled day, which will help you advance your understanding as a property business owner. Still about a week left to buy tickets at bit.ly/PBWFOUR, and there's also a link in the show notes. So, welcome to the supplement. It's one of those weeks where I've just cracked. I often flirt between mentioning certain things in dispatches, if you like, in passing, and then shouting about other things in a rather ranty fashion. Occasionally, I've been mentioning something for a long time, and then the dam breaks, and I have to go into beast mode and talk at more length. That's what's happened this week around the amount of highlighting, either cynically, deliberately, in order to confuse or to obfuscate, but generally speaking, I think due to ignorance or laziness of completely the wrong areas of focus, statistics, risks, and just data points in general. Now, I love the data because it doesn't lie to you. It's the people that interpret it that lie to you, and that's why I go straight to the data. It's my only friend in this game, ultimately. I've also read the vast majority of headlines from a media that is mostly, controlled by Republican or Conservative voting neo-oligarchs regarding the Labour Party, Starmer being a Trotskyite, communist, crypto-socialist, whatever, with a large pinch of salt. I almost exclude them as of right, but actually this week with the scandal, which will soon surely be widely known as Giftgate, I've seen their point. The problem is simple. It doesn't need to be the same as Boris's rotten to the core incestuous inner circle. Nowhere near as bad. Boris never ran on a ticket of being a good guy, and certainly not one with moral superiority. He just chatted well, wrote well, and people liked his hair. It's really their fault, or our fault, that he got voted in. I think it's relatively simple, really. If you're going to throw stones, no matter how small, don't live in a glass house, right? The more the days roll on, the more and more I recall the genius of George Orwell, who was just so far ahead of his time. Malcolm Tucker and the thick of it are the other parallel you can't help but draw. So, rant over temporarily, but that set the scene on why the deep dive this week. Before we tuck in though, we crack on with the macro after we've had the real-time market info. So my weekly credit to Chris Watkin, who delivers week in, week out on these real-time market insights, sometimes offering us some bonus content as well. The listings are still ploughing on. Another 38,000 homes went on the market in the UK this week, and that's back to 2024 business as usual, basically, after reporting on the bank holiday week. Big numbers. Now nearly 8% higher than pre-pandemic listing numbers this year. Net sales also outperforming, 29% higher than the equivalent week in 23, and the whole of the year we're nearly 16% higher than we were year-to-date 2023 at this point in the year. Mid-September sales agreed figures now see sold subject to contracts above the year's high in July price-wise. So it looks like a summer lull in terms of prices paid. That's well and truly over, and the active market is seeing the direction of travel move upwards. I'm still not seeing anything to change my 5% prediction for 2024 by the time the dust settles on the ONS figures. Listing prices were right back up to a number vastly above the 2024 average, and this is an annual phenomenon. Central London homes go on the market in this fortnight every year. So remember, we're reporting on the week that ended last Sunday here, so this is the back to school fortnight, if you like, that we're reporting on as a whole. Price reduction has really moved over the past 2 weeks, and we're now reducing 1 in every 6.5 properties per month. Chris doesn't think that's enough, but I think he says that every week, to be honest with you. With such high stock levels, that's a lot of reductions. Over 100,000 reduced properties every month at the moment in the UK, because we've got 710,000 for sale, which is also a high number by the UK standards. So still nothing to change the conclusion of the moment on this market right yet. Houses are selling, but they need to be fairly priced, and they need to have something to make them stand out from the crowd. Fairly self-evident, but worth repeating if you're trying to sell any stock at the moment. So moving on to the macro then. This week was another big one. Inflation. That would obviously be my mastermind specialist subject, the UK inflation rate from 2021 to 2024. The Bank of England MPC meeting, you won't have gone without noticing we had a meeting this week. And also the interest rate decision coming off the back of that. And then the GfK consumer confidence figure for September's survey. I've got plenty to say about that. And then we've always got our savour of the gilts and swap markets, again with plenty of commentary, although please don't get too excited for that one because it's not that positive. I then want to press on with some FCA mortgage lending data for the quarter, and also the real parts of interest and importance in the Bank of England meeting agenda for this month, which was not a main quarterly meeting with a full inflation report, but it did contain something which I've talked about with regularity as being extremely important, not just for moral reasons, but also for economic reasons. So, inflation. Once again we dance, friends. Less vigorously so than in recent years, but we still dance. The important decisions are really made at the forecast stage, and then how far we miss and in which direction, in terms of those forecasts, then determine the momentum and direction of the gilt markets for the following week or weeks to come, or until something else happens to knock that momentum off its perch, of course. On the headline number, which is CPI, we hit the consensus, staying at 2.2%. A few months back, I would have expected this to tick up a bit at this point, so I'd like to see that as good news. Good news that was already priced into last week's gilt prices, though. You'll know by now as well, we have to go much deeper. Core inflation, more reliable measure, less volatile, predicted to tick up from 3.3 to 3.5%, and tick up it did, but it ticked up to 3.6. That's what we call an upside miss, which is bad news for gilts. The ONS, largely on their own, preferred all these measures ending in an H. That incorporates housing costs. That's what H stands for. So, I think it gives us a much better picture of what real wage rises mean, adjusted for CPIH, rather than adjusted for CPI. Because ultimately, if you're earning, or even if you're not earning, you've still got housing costs to consider. There's been more volatility and upwards pressure on housing costs that we haven't really seen since the 1980s in the past few years. So, for the record, I think the ONS are right to focus on the ones with the H on the end, but they don't do marketing for statistics or whatever you might call it, so sometimes it must feel to them like they're shouting into the void. But when you wheel the H's out on the end, core goes up to 4.3, and CPIH core was 4.1 last month. Services CPIH goes to 5.9 from 5.7 last time out. Direction of travel looks all wrong at the moment. Without the H, services went back to 5.6. It had recently been as low as 5.2. But all this stuff starting with a 5 is not generally good news and doesn't really calm down the members of the Monetary Policy Committee. So, let's be clear. All does look reasonably well, although it still feels like the 2% inflation target in the UK or the US is more of a floor at the moment than a target. Pandemics have this effect. I've cited this many times in the past several years. An extra 0.5% to 1% of inflation is not uncommon in the aftermath, which in old money terms lasted between 20 and 40 years. Now, the world is a bit different, although not as different as we might think, when it comes to economic phenomena. Still, that's the best data that we have. Then it would take a real shift of mindset, something I started advocating for a few years ago. Move the inflation target on the back of this. What's the logic? Well, there's excess inflation in the system for potentially a couple of decades. Target 3%, plus or minus 1%. Radical. Not the sort of thing a public sector employee would do. Why raise your head above the parapet? For what reward? Very, very risky from a career perspective. That's why I don't work in a large organisation. I wouldn't be able to resist doing it just because I think it's the right thing to do. And I wouldn't mind putting myself out there to be shot at because I have strong convictions and I've done the research. We also always need to remember that really this shouldn't be such a huge influence on the Monetary Policy Committee decisions to lower, raise or cut the base rate. And there isn't really too much evidence that it is. They talk about it a lot in the US, the Fed having relatively knee-jerk reactions at the moment. I'm not sure that it's true. I'm not sure there's a lot of evidence, but of course the Fed did cut the rates by 50 basis points this week, which historically has always been an admission there's fairly significant problems coming. So I guess we'll find out in the US. There's no real klaxon sounding in the economy there to suggest there's a big economic crash coming or anything like that. But it makes me chuckle really because the Bank of England meets 8 times a year to discuss rates unless there's an emergency or a vegetable-esque decision made about who should run a governing party. And the vast majority of the time, the bank votes not to move rates. Rate rises and cuts take between 6 and 24 months to make a real impact, according to those who make up the Bank of England Monetary Policy Committee. Their independence should, theoretically, allow for apolitical decisions that protect the best interests of the people and the economy. Some more on that, though, in the deep dive. Back to the inflation metrics. When we're talking above 4%, the bankers really don't like it. Above 5%, there's a risk that people start using phrases such as stagflation, hyperinflation, and the likes, which is not good for business overall. Not bad for government debt, of course, fixed in nominal terms the vast majority of the time, not the index-linked stuff, for example. But each month that goes on, one more screw is tightening. This is the first concrete example this week of the torch being shone in the wrong place. CPI is important because it's what the Bank of England are tasked with controlling by the government. It's also, at least 90% of the time, the wrong metric for them to be concentrating on. CPIH is better because everyone needs H. If they aren't paying, we're all paying. So if you see what I mean there, ultimately, if you're not paying for your own housing, the state is paying, which is why housing is important, right? OOH is drastically undermentioned, the owner-occupier household inflation measure. I don't think I've ever heard one single other individual commentator or journalist ever mention it. But OOH is synthetic, right? It's a made-up metric, for want of a better word, but it's a proxy for an index which measures how much it costs their owner-occupier for their housing compared to 12 months ago. And that metric this month reached 7.1%, the highest ever, a new high, a higher high, going back to March 1992 when they first created this series at the ONS. The biggest inflation since before 1992, of course, is what we've been through in recent years, so perhaps it's not a massive surprise. But you'd think you'd get more airtime here because this squashes people's confidence, decision-making, risk-taking, and overall investment. Ultimately, if that's what the house is costing you to run, these are costs you can't really opt out of. If you start opting out of them, if you're a renter, you're going to get evicted. If you're a mortgagor, you're going to get your house repossessed. So you can't opt out of these costs, ultimately. But everyone ends up scared of their own shadow because it's tightening the household budgets before money can go out the door every month. OOH being so much higher than all the other metrics that I've talked about, at over 7%, explains that why we add that H to those inflation metrics described, they go up, not down, because they've got this housing element in them. The record levels on the upside are only incorporation, including co-partnership on the loan agreement with the SPV. So, my feeling last month was we're really approaching the high in this metric for a few reasons. Firstly, as of about now, maybe a month further on, we would see the end of all the 2-year mortgage deals, which before the trust debacle was still pretty popular. The inverted yield curve, making them much more expensive per annum, the 2-year deals, than the 5 years were, plus the overall once bitten, twice shy feeling, meant they've got a lot less popular, the 2-year deals, in the interim, of course. They would and could still have been completing until December 2022, or perhaps even later, but the number of them will be tapering off fairly quickly. So we're not quite there yet, but we're nearly there. Now, after a charge up to about 4.25% or a bit higher level on the 5-year in around April 2024, the yield curve had fallen right back, meaning that anyone dropping off 5-year 2019 mortgages, which were at a very nice low rate, although not as low as we got in 2020 and 2021, were not paying quite as much of a different rate as they were in the middle of 2023, when the yields were 5%, or on the mortgages from April 2024. So people also, as a rule, can start switches 6 months in advance, and anyone with a modicum of financial sophistication which is really the entry-level criteria for having a mortgage. And look, you can expect households to put a lot of effort in here, because ultimately it's the single biggest expense almost always for the average household if they've got a home that they own and a mortgage. They'll have been looking at rates for some time. They'll game the system where they can, take an offer, you've got 14 days to do something with it. They'll just check if the rates have gone down or they haven't gone up. If they've gone up, they might accept it. If they're still the same, get a new offer, etc., things like that. So I think you can expect a lot of people to be behaving like that to try and make sure whatever the increase is kept down to a sensible one. So I haven't changed my mind from last month on us being near the top on this OOH metric, but I still don't have a strong conviction on calling the actual top in this metric quite yet. As usual as well, just when it came to the base rate, whilst it's nice to call the top and it shows you're on top of your numbers and all the rest of it, the really important metric is how long you stay near the top, or how slowly it takes for the metric to recede. So look at metrics like wage increases without bonus, or services inflation. As I said, services CPIH back up to 5.9 this month shows just how sticky that's been at what anyone with a clue would call an excessively high level. So overall, my sense would be this metric is going to stay stickily high, and the reality of the Renters' Rights Bill, as discussed in detail last week, is that rents are likely to be pushed higher by a combination of further reduction in stock and affordability outside of the larger metro areas still being there, in spite of the fact that rents are taking a higher percentage of earnings than they have done for a decade or more. There was an acceptance or even an entitlement to the fact that the rents moved below inflation and were steadily for 15 years taking a lower percentage of a household's income. But of course, this was not a right, just a symptom of a moderately functioning housing market and economy, which at this point in time is a thing of the past, it seems, without a credible path to working again until or unless these 300 or 370,000 plus homes per year actually start being delivered with a very healthy slice of affordable in the right locations. And that's certainly the stated goal. Will it be doable? Will it be delivered? It's also worth noting that oil dropped right back below $80 a barrel in August, and it actually carried on down into September, down to a recent low of $66, although it's bounced back above 70 now. Now, some of that is due to fears for the global economy, and there were a couple of points in August, flash points, where the stock market, the S&P 500, went down quite significantly in one day. When there's concerns over global demand, the oil price tends to come down because not as much oil is used if people aren't expanding their economies apart from anything else. So that might have helped with motor expenses. That might have been worth 0.1%. I was expecting this print to be 2.3, not 2.2. So I was slightly off. That was the last time I looked at that was about 6 weeks ago. I also run some polls on this sort of stuff on LinkedIn for people, because I think I get good insight. The sort of people that are following me and are contributing to those polls are actively in the property space, have got a pretty good idea of what's going on. They don't think, as a whole, inflation is going to go back above 2.8, and a really decent percentage believe we aren't going back above 2.5. I'm not quite there yet myself. There's base effects to consider. October, we know energy prices go up 10%, and we know other things may be dragged upwards with them. They won't be released till November. I'm not quite that positive, but I'm very happy if we're arguing over 0.25% or so on the inflation rate, because that suggests a functioning and under control inflation rate. My feelings that we would go back above 3% at this point look a bit too bearish, but we do need to see how these energy prices play out, and we do need to point to the fact that, well, core inflation is still at that sort of level. It hasn't calmed down yet, neither have services. Wage rises next year are probably going to persist. Minimum wage is already set to be relatively high. Doesn't feel like a 2%-ish inflationary economy. It feels much more like a 3%-ish inflationary economy to me. So let's see. But anyway, it's a bit like we need to consider what's going to happen as well with higher energy prices to demand, because normally at this point in the year, this is when gas prices are going up as we go into the winter, because demand becomes active as we approach the winter. Anyway, we're still only in autumn at the moment, of course. I don't really refer to places like the Daily Express for my weather forecasts when I have a look at them. I like to look at the Met Office, and I also like to look at some long-term forecasters. Now, what we can see for the moment is the same of the rest of 2024. Temperature slightly above average, wetter than average conditions. So the Met Office only go 28 days. Some use climate forecast system version 2, a widely used model on the internet, for 6-month forecasts as well, and they're suggesting temperatures staying at or around zero at the lowest we get this winter, with wind really picking up in late December until mid-January. So that's their best stab at the storm season when we start getting all the names for everybody out. But look, it's a 6-month prediction, so I'd take that with about the same pinch of salt as you would a 5-year interest rate forecast though. But you wouldn't expect gigantic gas demand, although of course there's much higher gas demands than there are in the summer when the temperatures are down there. So we do know that the warmer it stays, the wetter it gets. That's given us from recent experiences, but this run of milder winters, if we include this winter coming, and this is correct, this long-term forecast, it's been incredible timing given what's happened with gas supplies and prices overall since early 2021. But as usual, when you get lucky, nobody talks about it. No governments can claim credit for what happens in the weather just yet. And the news and the revolving doors of crisis make their money and get your eyeballs by being reactive rather than proactive or calm and collected. Okay, inflation does look a bit calmer, but with those various caveats and a slew of measures still far too high for comfort. And perhaps this explains a bit to you about why the Bank of England are not acting faster. However, back to my soapbox of this week and the spotlights, everyone looks, cares and reports on the decision to cut or hold the rate. There wasn't really a lot of thought that the rate would be cut here. Going back a month or so, there was some in some corners of the economic community space, but I did tell you back then there was no chance of a cut this month. Once we feel we know where we are, the thoughts then go to which way the vote is going to go, because remember there's 9 members of the committee, and that tells us a bit more about who might move next time out. So if you're getting this right, you have a real handle on the way the committee is thinking. I felt quite strongly this month that Dave Ramsden would stay in the cut camp particularly, but I've obviously read his voting intentions wrong, or what's really informing him incorrectly. So I thought there was actually a live chance of a 6-3 vote to cut, because there's a new member of the committee who's replaced a hawkish member. We don't know a lot about this new member of the committee yet, Alan Taylor. They're always very, very careful not to sort of let you know too much about whether people are particularly hawkish or particularly dovish in which way they're going to vote, but you find out pretty quickly anyway because of the minutes of the meeting. And if you analyse the way in which people vote, you soon find out where they sit on the spectrum. But the actual result this week in the committee was 8-1 in favour of holding the rates. That was right in the face of a Federal Reserve cut of 50 basis points. And that was a bit of a surprise to the city, this 8-1. I say on a regular basis, I don't think the Bank of England are anywhere near as influenced by the Fed, by what the Fed do, as the markets seem to think. But to an extent, we're price takers in this market. And so knowing what the market is going to do is as valuable as knowing what the market should do, frankly. Most sensible consensus also thought Ramsden would stay across the floor and the vote would be 7-2. It puts doubt on the cut in November, this 8-1, although I've stated my position on this several times. This was being priced at nearly 100% before Thursday's meeting. Now we're back to a point where it's perfectly viable to believe that 7-2 or 6-3 is needed in the next meeting before we have another cut. So anyway, in this part, I'm only focusing on the high-level meeting. The real news of this meeting is waiting until the deep dive. But the gilt markets had already reacted to the Federal Reserve 50 basis points cut, which was followed by a very hawkish conference afterwards saying that rates would stay higher for longer by Jay Powell, Federal Reserve Governor. And so the bank meeting result did very little to move the needle, actually. It had already moved. Although really it was the opposite result from the Fed, because they didn't cut. So much for this following the Fed stuff, right? We didn't cut. We'd already cut before the Fed did, but we had more calming words, or at least attempted calming words, from Andrew Bailey, the governor, who's not the greatest communicator in the world. So we then had what's the most frustrating news of the week. The GfK Consumer Confidence release on Friday printed a nasty -20. Consensus was that things would remain the same, but do you know what? Who'd have thought it? Create a bunch of miserable headlines about how much everybody in the middle class, and everywhere frankly, is going to get absolutely shafted in the upcoming budget, and people will start saving more, cut their spending, and sit and wait like powerless victims for the almighty beating they think they're going to take. So will businesses. Go figure, Kier. One thing you need to learn is that you need to lead with inspiration, not with misery. It isn't our fault that the Conservatives did what they did. Okay, we elected that idiot with the funny hair, but the whole lettuce thing, that really wasn't our fault. So making us feel like naughty school children really isn't on, and it's economically the wrong thing to do for the country. The -20 print is nearly back to the lowest print of this year, and it feels a lot more like an end 23, early 24, when people weren't quite on the bus yet, that the economy was going to be improving. Although if you've been watching or listening to the supplement at that point in time, I did tell you that's exactly what was going to happen, and that is what's played out. And one of the reasons I'm so frustrated is there's no need for this idiocy to knock us off our perch, but knock us off our perch is exactly what it's done and is going to do. So we'll see the impact on consumption and spending in September's figures, of course. These were August figures that we had this week, and they were from the retail sales sector and were above consensus. So the survey is very much real time. That's September's consumer confidence. But the retail figures that released on the same day are actually August figures, and they did better than the consensus feeling. But the feeling is what will persist and define economic activity over the next couple of months. And when we're just on the right track, this negative rhetoric has just started to derail the train from the tracks. And if I sound frustrated, it's because I am, right? It's surely self-evident to say that after a pandemic, and not that long after a global financial crisis, confidence is fragile. And guess what? You also need to earn the respect and trust of the British public, rather than assume it is coming because you are better than the other side. And even if your sleaze and corruption is at a lower level, but very much still there for us in the general population to see. I think it just beggars belief how naive they can be. Although I guess that given none of them have done one of these jobs for at least 14 years, and most never before, of course, and most have never been in business or similar, perhaps we shouldn't be surprised. I had high hopes for a government that would appoint a James Timpson. It seemed like a positive, progressive move and a statement for the future. The statements at the moment are, leave me alone, I'm allowed a free holiday from people with money. How can they not see that it's so obvious to all of us there's no such thing as a free lunch, and we're left wondering what is expected in return for these favours? When politicians go around saying nobody does it for the money, and then getting the trappings of wealth showered upon them by third parties, this is not a hatchet job by the press or anybody. This is calling out hypocrisy for what it is. Anyway, back to the data, calming down from DEFCON 1 to about 2.5. GfK themselves said it was a big fall this month. There have been major corrections in the outlook for our personal financial situation over the next year. That's down 9 points in the survey. The overall index was only down 7 points. Views for the economy for the coming year, which is the self-fulfilling prophecy of all self-fulfilling prophecies, they're down 12 points. And the major purchase index, which of course is down 10 points because everyone thinks they're going to be skint. This is a cock-up in expectations management beyond all belief. It's even impacted the OBR report, probably, which the budget's going to be based on, although they might well not be looking at the data and instead looking at older data, which might save Rachel Reeves this time round, and us a little bit. It's probable at this point that a more positive than it should be now forecast will emerge from the OBR. Remember, this forecast is what governs the Chancellor's fiscal manoeuvres and policy, or in plain English, how much she's going to put tax up. So, winter fuel axing is seen as a thing to come. Pensioners are quaking over the removal of the single person's council tax allowance. We've got to the stage where everyone's scared of their own shadow. So well done, Kier. This is the result you're going to have. Economic growth flatlining because of that. You know, and what would the removal of the single person's council tax allowance do anyway? It will hurt the old, and it will hurt the single parents who are mostly female, right? The hardest groups to pick on, and I don't know why they would. Find the money from somewhere else. Make a U-turn on your ridiculous policies to promise not to put taxes up. You've got to. So get on with it, and the whole population is going to have to pay, not a few people. So the story from the GfK barometer is it's nearly undone 9 months worth of positive economic work. I'm raging because if this has cost us 0.2% in growth, and look, we'll see flash PMIs and things like that next week, and I'll be talking about them here. That's a couple of billion in tax revenue per year that needs to come from somewhere else at some point, right? The communications people, whoever they are in this administration, in number 10 and number 11, need to give their heads a wobble. Okay, extra blood pressure tablet taken for good measure. On with the gilts, which unfortunately won't cheer anybody up who's listening to this. We opened the week at 3.498, the bottom of my range for the year. And to quote Yaz once more, the only way was up. When the Fed cut by 50 bips, this was seen as a front-end only benefit to the yield curves around the developed world. Cutting the short-term rate, of course, because the funds rate is it is the 3-month gilt yield. Basically, they are pretty much the same thing. But it raised the longer duration yields, including the 5-year that we're most interested in. The cut was announced when our markets were closed Tuesday evening. But so on Wednesday, after we closed at 3.527, on Wednesday we opened straight up at 3.664 and trended upwards throughout the rest of the week. We bumped our heads at 3.8% yield, a big increase, and we closed at 3.752, a straightforward quarter point on from last week, blowing all those beautiful gains from last week. You know, it's a bad sign when I have to go on about it in detail, and that's all I'm going to say. The swaps on Thursday, we closed also at 3.752, and incredibly, the last swap traded on Thursday was at 3.514 for the 5-year. This is a huge discount. It won't last, but at least we can hope that some lenders in the past week have taken a nice slice at 3.5%, which will allow them to continue being competitive on mortgage rates as the next few months play out. For context, it all still looks pretty sweet compared to the swap rate 12 months ago of 4.4, which was effectively unworkable for vanilla buy-to-let in more than 50% of the country, especially if you're after 75% or more LTV mortgages. So look, it's bad news overall, but it's had limited effect on mortgage pricing for the moment. Let's reserve judgment for another week on that swap market and see how close the gilts and the swaps come. Right, that's a wrap for the macro, so we can move on to the meat. Firstly, the quarterly FCA lending data. It's been available for nearly a couple of weeks now, but the last 2 weeks have had some drop everything supplements, as you'll appreciate. I didn't want to wait any longer because the data's already a bit stale before they even release it. But it's very important and the most accurate numbers we get out of the lending market, so here we go. The total size of the mortgage sector in the UK back to £1.661 trillion, 0.3% up on a year earlier. Shows what a tough 12 months it's been for the sector, but at least it's back to growth. It grew 0.4% last quarter alone. Remember, we're talking about Q2 2024's data here. So the mortgage recession, if you'd like to call it that for the lenders, is clearly over now. Lending to be advanced in the coming months was up 11.3% quarter on quarter and 12.5% year on year. So those are mortgages that are going to complete in this quarter that were known about last quarter, which is not every single mortgage, of course, but it's quite a lot because it takes about 3 months to go through a process. Obviously a fair bit shorter if you're going through a remortgage, especially if it's a product transfer. But significant improvement, and that's bound to have filtered through into what we've been seeing in the real-time housing market and the figures that Chris shares with all of us. So that all looks fairly congruent at the moment with a relatively positive and upwards moving market with a little bit more mortgage financing, but very sustainable increase and still plenty of room yet to go in that sector. So house purchases by percentage of debt increased, which means that remortgages decreased. The buy-to-let number, which is the one I always watch and report on, stayed at 9%, or 1 in every £11 lent, if you prefer. For a sector that houses just under 1 in 5 of the population, I believe this speaks volumes. The downwards trend has been snapped off, as we suspected, but there's no way replacement in this sector is keeping pace with organic and inorganic drop-offs, which is basically deaths and sales from exiting landlords, right? The 9% number is historically very low. The 10-year average around 13% puts things much more into context, I believe. Now, you might not think, well, 9%, 13%, what's the difference? But there's a huge difference between those two numbers, because to go from 9% to 13%, you've got to increase by nearly 50%. So it's going to take an explosion in buy-to-let for that to happen. And at the moment, you'd be rather surprised if I was talking to you within the next 12 months about some kind of explosion in buy-to-let. Other good news, though, both directionally and absolutely, new arrears cases decreased by 0.5% from Q1, and that's 5.3% lower than 1 year ago. That recessionary side of the market is firmly behind us, and whilst lenders obviously want arrears balances downwards, the direction will stop concerning anyone. That only speaks to new cases, though, of course. Balances with arrears are up 2.9% from the previous quarter and are up 32% on a year ago. Basically, fewer people are starting to get into trouble, but those who are already in trouble are struggling to get out of it. and the situation is getting worse for them as an aggregate pool. We went from 1.29% total balances with arrears to 1.32%. This is not a meteoric rise, but it's a rise nonetheless. It will see lenders starting to take more aggressive action against longer term arrears in the near future, you'd think. The arrears balance is the visual for this week, so if you check out the article on my LinkedIn or on the Partners in Property website, you can see that visual because the picture says 1,000 words. Still rising, but rising at a much more manageable pace and looking like it's bumping its head along the top somewhere. Higher loan to value mortgages above 75% and indeed above 90% are higher as a mix of the percentage terms of loans being issued than they have been for years. Clearly the incomes are stretching, and high rents are pushing those who do have to stretch more to buy into buying properties. I'm constantly surprised anecdotally at how many renters are making a choice to buy when they were making a choice to rent before. The government told me that I only imprison people into rentals and they can't buy. So if someone can explain to me how this is happening, I'd love to be educated. That is sarcasm, of course. It is an interesting trend. 42.8% of mortgages exceeding 75% loan to value. Perhaps it's also a sign that people are confident in pricing right now and they can take a bigger percentage mortgage because the lull in prices for the past 2 years does look like it might well be over to the average viewer of the market. Of the basically £22 billion in arrears, isn't that a strange coincidence? £5 billion is non-regulated, i.e. mostly buy-to-let. The result of these rising arrears, well, new possessions are down 5.6% quarter on quarter, but they're up 33.2% year on year. And the number of stock possessions at the end of Q2 was 6,480, which is 34.5% up on a year ago. So I'd expect some more repos, but also appreciate at about 2,000 per quarter happening across the country, it won't exactly be raining repos down from the sky, but there are more of them out there. So that's mostly good news really from that report, with the upward trends that we didn't want to see coming to an end. However, if less than 10% of new mortgage money being for buy-to-let is the new normal, and this is the 6th quarter in a row, so that's 18 months under 10% of new money being for buy-to-let, the low being 7% in quarter 4 of 2023, then the stock issues in this rental market are not going to be sorted from the supply side at any time in the near future. So now on to the real meat of the Bank of England meeting. I've been on this soapbox for what feels like forever, but it's actually about 18 months since my first musings on the subject. The subject being quantitative tightening and how best to go about it. So before I get into it, there are a few things to draw from the minutes of the meeting. It's a non-full report meeting, but it does contain these important points around QT and some other factors. So the bank talk about 3 possible scenarios they've looked at. Global shocks dissipating, meaning weaker pay and price setting dynamics. It's a little bit of what's played out so far, but it's definitely fair to say that's played out very slowly. Inflation persistence fades away, allowing rates to be cut. That's the base case, if you will. Number 2, GDP falls below potential and the labour market eases. Maybe because some Charlie runs his mouth about how much trouble we're all in and how we'll all be paying for it whilst he gets his clothes for free. Okay, enough. Inflation fades away because consumption drops. And note it would be dropping further than it already has, of course, and then rates get cut. Or 3, the economy has structurally shifted thanks to supply shocks over the past few years. This is the stronger for longer case about rates. Rates stay higher for longer duration. They're not going to go up from here, realistically, in any potential one of these 3 scenarios, but they'll stay higher for longer. So if you understand those and can put those together in your head, those 3 cases aren't necessarily mutually exclusive at all. I'd argue there's been plenty of one with pay and price setting starting to dissipate away, especially on goods, but also a bit in services. And there's also been plenty of 3. There are structural changes to this economy, and we've been stronger for longer, much stronger for longer than the bank predicted we were going to when they were talking about this stuff in 2021 and 2022. And then 2 seems to unfortunately be occurring. I'm blaming Starmer, as is quite clear, for his very negative rhetoric. But then if that's going to drop interest rates, maybe I should be all for it, because I can't control what these idiots say to the economic actors of the nation. I'm too weak on brutal self-interest, and I care too much about the wider economy and the country as a whole. So the big takeaway really, though, to take from the bank's summary of the minutes is In the absence of material developments, a gradual approach to removing policy restraint remains appropriate. Monetary policy will need to continue to remain restrictive for sufficiently long until the risks to inflation returning sustainably to the 2% target in the medium term have dissipated further. The committee continues to monitor closely the risks of inflation persistence and will decide the appropriate degree of monetary policy restrictiveness at each meeting. This should really be taken at face value. This is why I've been saying a cut in November is not a guarantee. Okay, into the full minutes of the meeting now, but don't panic, it's not a line by line or anything like that. In the intra-quarterly meetings, there's rarely much of substance anyway, and they don't use updated forecasts based on the ones they used for the meeting in August, which is a bit of a joke really, isn't it? But there we go. At this one, there's now the annual decision on the pace of reduction in the stock of UK government bond purchases held for monetary policy purposes. What a snappy title, eh? What does that mean? Well, it means that since no one else was stupid enough to buy the debt at ridiculously low yields, we bought it from ourselves. Yes, really, that's what we did. From an accounting perspective, the Treasury borrows it from the Bank of England. We still, the quaint people that we are, prefer to call it money printing. In reality, it's digital movements on ledgers and registers, primarily. We were easing from 2009 because the interest rate was so low, it didn't attract many lenders, and also we didn't want to put the interest rate so low that it went negative. We felt we had nowhere else to go apart from to use this quantitative easing strategy. It's always a bit of a chuckle as well, because the bank goes about this first of all by marking their own homework. In a surprising move, they start by offering themselves full marks for their efforts. Near genius if you listen to them. My assessment is far more scathing. Here's the rub. They could really do three different things. Now, there was about £1 trillion of all this that was created, right? From 2009 all the way up to 2020. They kind of went to the well, and then there's 4 real points in time where they were like, actually, we'll have a bit more of that. It's helping, it's doing this, it's doing that. We need more. We would drop rates if we could. We can't really, so we'll do some more easing. I mean, they're not quite equivalent, bear in mind, but they are the two tools really that the bank has without actually injecting money directly into consumers' hands, which is exactly what happened, of course, when it came to bounce back loans and things like that in the 2020s. But anyway, they could hold this debt they've created forever. Then the money we're paying on the national debt, or some of it, would always be going back to ourselves. I know it's a bit confusing, it sounds a bit like a scam, and if it wasn't at government level, that's exactly what it would be. Plenty of people do call it out as a scam, of course, but many of them are a bit too woo-woo for my liking. Ponzi scheme isn't a bad assessment, but if we were to keep rotating the debt for all time, that really would take us into choppy waters, although of course it's what a lot of big companies do. It's not really an option, but if we could wean ourselves off it very, very slowly over the course of decades, for example. And how would we justify that? Well, on the basis that a financial crisis comes along about once in every 75 years from the data that we've got, and a pandemic comes along about once in every 100. So a 30 to 50 year unwinding of QE would not actually be unreasonable. But what do I know? Second choice, let the debt that we did print in this situation expire organically. So the Treasury pays back the Bank of England at expiry. Really, more accurately, loans given get removed from the system when they're repaid and expire. The money supply, therefore, goes down. Less money for the banks to lend, apart from anything else. Is that a bad thing in times of excess inflation? Well, the perfect idea, you'd think, if you're a regular supplement reader or listener. And guess what? You're right. However, with it being the public sector and all, this overall dominant strategy does not get enough airtime because people are boxed into a tighter remit, which leads to us all being worse off. Tens of billions worse off as it goes. Oh dear, the shouting has started again. Number 3, we could let some of the debt organically expire and sell the rest into the secondary market. So let's be clear, we bought at very low yields, which meant the bond prices were very high. Yields are now acceptable again, and in many circumstances over the past 2 years, they've actually been investment grade for government debt. If you ever listen to any of the broadcast episodes I feature on with Manish Kataria and Rod Turner on a quarterly investment mastermind basis, you'll note that I've talked about government gilt purchases twice in 5 episodes. I've been so convinced of their long-term value, specifically the 30-year. So, the logic goes, we as a nation buy high and then sell low. Oops, even Samuel told me that wasn't the way to go. So what's going on here? Well, the best logic I've ever extracted from the Bank of England here, not for want of trying, is that they'd like to start from a lower base if we need to use QE again. And we should unwind the position more aggressively because the interest rate is back in play as a fiscal lever. And the cost to this to the public purse is indeed tens of billions. Who's establishing the value or not to the taxpayer then? You'd be entitled to ask that, you would hope. Oh, no. This is the public sector. That's not the bank's remit. So if you can't see the smoke coming out of my ears right now, believe me, it is there. I've seen some idiocy in my time. Indeed, I've even participated in some on a far too regular basis. However, this really takes the biscuit. How the third strategy, the one being used, is in any way dominant to the second strategy, where we just let things expire, I don't know. And the first one hasn't even had any airtime, which is ridiculous. We're talking about tens of billions of taxpayer money here. Anyway, I've set the scene. Let's see if the bank marks their own homework with full marks once again, completely glossing over these smaller matters that run into the 10 figures before we get to the pence part. The top level decision is they want to reduce the APF, the overdraft, if you like, the asset purchasing facility, by another £100 billion over the next 12 months. So we're about 650, 660 at the moment. This is going to take it more down to 560, right? And bear in mind, we were at £1 trillion. So we're not quite ready for Bon Jovi yet, but we're nearly going to be halfway there in 12 months' time. They refer to continuing to reduce the risk of the bank having a bigger balance sheet over time. They don't quantify it. They don't measure the benefit of it, certainly not in terms of what they share with us. Perhaps they do privately, but you'd hope this would make it into the minutes. Their plan to use the interest rate and then not to disrupt markets, and then to be gradual and predictable, sounds a lot more like my number one to me than their number three, what's actually happening. Their lack of understanding on the right timescale is likely the biggest issue here. They now, every time, wheel out the fact there's been no negative impact on gilt sales. Well, that's not really a surprise when now they represent a real return and are trading a bit higher in yield terms. Now, the bank guesses this is about 10 or 15 basis points. So this costs the government even more money by following this strategy because they pay extra interest on all the new debt that they issue in the time. They issue debt all the time through the debt management office because debt is dropping off and then it's being created again, and they have debt auctions, bond auctions, things like that. The bank guesses 10 or 15 basis points. I think it's more, personally. That's a personal view. The data they offer and the evidence they offer is very, very weak. I wouldn't be surprised if it was more like 25 basis points. And look, 0.25% might not sound like a lot to get worked up about, but you've seen evidence over the last couple of years that 0.25% can be a difference between being able to buy a buy-to-let and not being able to buy one. And that doesn't help the market in any way, shape or form. So the bank goes on to say it hasn't affected the path for bank rate in the future. Well, I suppose that's good, but doing it more slowly also wouldn't have affected the path, would it? So the only bit of good news coming out of this section, I'm afraid, is that of this £100 billion clipping coming over the coming year, 87 billion is maturing bonds. So we can live with those, right? No losses booked anywhere, no third parties involved. The Ponzi is healthy, the loop remains closed. The other trifling 13 billion will be sold at a big loss, of course. Nobody worries enough about that to say just how many hundreds of millions and billions that does cost, of course, because it's not my job, mate, and that's that. So, on to their evidence for their own excellent work then here. They actually set it out in August's report, but we're also excited about the first base rate cut for some time. I focused my efforts that week elsewhere. All we really get is how they've measured it perfectly, it hasn't affected anything, and in not so many words, just how very clever they are. There's no point going any deeper than that. It's the question that doesn't get asked, or indeed, once again, the spotlight not being shone on the right thing, that winds me up so very, very much. We have to refer to the OBR or other bodies to tell us just how much it all costs. This, you might remember, was one of the policies that Reform almost stumbled upon by accident, although they preferred to concentrate on not paying bank interest on deposits and saving 40 billion, which would instead have destabilised and crippled the banking sector and completely wrecked margins on mortgages. But go easy on them, they don't yet understand economics, and as mega populists, they won't really seek to. But one klaxon from Box A in August's report, though, that I've referred to. It did identify the 87 billion that was coming up for maturity in the following year. Next year, that number's 50 billion. The year after, it's 33 billion. So these on their own aren't necessarily going to get the Bank of England to where they want to be. It probably means more wasted money in future years on their current preferred way to manage this risk. And I'm just not all too convinced of their risk pricing, and their lack of cost-benefit analysis is, straightforwardly, a crime. I don't hold the bank accountable for this, to be clear. I hold the government accountable, and particularly the Chancellor and the Treasury. This is disgusting, and it can only mean one, or a combination of the following. Number one, weak leadership in the Treasury. And I'm not just talking about Rachel Reeves here. This has been going on over the last several years. So this is regardless of the colour of the party. Number two, chancellors who don't understand economics. And yes, we've definitely had some of those. Rachel Reeves is not one of them, but she also isn't doing anything here. Number three, a sickening mindset around public funds. Or number four, a lack of competent advisors to get stuck in where there are billions to be gained or saved. I hope you can see just how frustrated I am about this. And I do thank you for listening to what is, let's face it, a bit of a niche rant that borders on the ramblings of a madman. However, if I don't care and we don't care, then who does? Now, this is exactly why I end up telling you and myself every week that the only way is, of course, to keep calm and carry on. And before I go, you can still book your last minute tickets for the 4th Property Business Workshop of the year, bit.ly/PBWFOUR, link in the show notes, Tuesday the 1st of October. If you miss it, you'll regret it. There are no recordings, and we're not just repeating them once a year or anything like that. It's fresh content every time. So, there's only one way to deal with this emotional barrage of rhetoric, whether it comes from the media or whether it comes from other sources. Keep calm, always listen to the supplement and carry on. The future is seriously bright in the investment side of the sector. For the wrong reasons, to be honest, primarily mismanagement. But if you know how together we can fix that, let me know, because I'm up for being part of the solution. I'm going to be around in Liverpool tomorrow for the Labour Party conference. Any interested listeners who've got to the end and are still listening at this point, I might see you there if you're there yourselves. Have a good one, and thank you.